Although most analysis of Nigeria's investment worthiness concentrates on headline events and incident-based shocks, the true picture is that economic, structural, and institutional factors play a much more important role in the dynamics of Nigeria's economy and business environment. In terms of its economic fundamentals, Nigeria continues to hugely underperform its growth potential. Even a focused and successful concentration on just one particular facet of the barriers to investment, for example, power supply or security, would unleash further growth synergies which would reinforce and accelerate the upward trend. While we anticipate that these reforms will kick in soon, we can't take our eyes off our crucial macroeconomic indicators, GDP growth, inflation, and others. Well, she's no stranger to Business Week, so I'm glad to have with me here in the studio to review these indicators Chinwe Egim, the Chief Economist and Head of Economic Intelligence at Coronation Merchant Bank, to analyze these indicators. Welcome on the show, Chinwe. Great to have you as always. So the first question I wanted to ask you was on the rate decision by the CBN. What do you make of it? Is it enough to tackle inflation?
Well, okay, so let me start by saying that for a monetary policy committee that has been postured as inflation targeting, the rate hike was not surprising, or expectations around that wasn't far-fetched.
So you expected 25 bips, 25 basis points?
Well, no, I expected a hold stance or a rate hike.
Okay.
Now, with regards to the degree of the rate hike, that differed a bit. We've seen them raise by 150, 150.
In the past,
yes,
right?
In the past. And now we're seeing 25 basis points, right? And if we look at other central banks across other areas, like the Federal Open Market Committee of the US, the ECB for Eurozone, and then the Bank of England for the UK, you would see that the posture is still that of raising rates, right? But I do acknowledge that for each economy or each country, that tailored solutions should be made for each country. Now, what does this rate hike signal? It's 25 basis points, right? Smaller than what we've seen in the past. But every rate hike does signal a trending up in lending rates. Also, upticks in fixed income yields as well. And that has some kind of impact, or it reflects on borrowing costs. Now, there are concerns around non-performing loans spiking.
For the banks?
For banks, yes. And this is not just on the back of the policy rate decision. We can see what's going on with inflation.
Yes.
We can see the announcements that happened with the PMS subsidy removal, which, by the way, I think is a positive step. But of course, there's going to be economic pain before the gains come in. And for companies that are largely focused on consumer goods, they're going to experience more soft demand, and that could impact sales. You know, so of course there are concerns around NPL spiking.
Yeah. So I want to ask you this question. Is the rates, the monetary policy rate instrument, really the best hope of tackling inflation? Because, you know, I've always wondered, you know, if you're speaking to somebody who's a non-economist, it's like, we're just so obsessed with rates. But are there other things we can do to tackle inflation?
Well, so I say this a lot, that in Nigeria, inflation is really a blend of demand pull and cost push. Demand pull is where you would find the policy rate actually helping. That's when there's so much liquidity in the system and you're trying to mop up liquidity. But then cost push, that's more from the supply side constraints angle. It's something that we've been dealing with for so long. So solutions around security challenges, infrastructure, deficit, power challenge, all of that needs to be tackled. Logistics. If we're able to tackle all of that, then we should see significant declines in the inflation rates.
Yeah. And so do you have forecasts for inflation?
Yes.
And so what are you predicting? Because right now we're on 22.9 or
yes,
thereabouts.
About that, yes. Yes.
That's a headline inflation.
That's headline, yes. So that is actually what people project, analysts project the headline inflation. So yes, I expect inflation to continue to record upticks, at least to the end of this year. We have it at 24.9% for the end of this year.
By the end of this year. That's Coronation Merchant Bank.
Yes, Coronation Merchant Bank, yes. And we did take into consideration the PMS subsidy removal. And then there was another little increase in pricing of PMS recently. So we've factored all of that in there. Now, when you're doing your modeling, your inflation modeling for Nigeria, you find that the months that are seen as harvest months actually record lower month-on-month inflation. So our harvest months happen in the third quarter of this year. And then you also have like a seasonal effect or seasonal boost in December. It's something we've seen periodically.
Is that the spending or?
Yeah, NDF festivities,
okay,
yes. Yeah. So there's usually a surge. So putting all of that into consideration and some qualitative analysis as well, we also included the impact or transmission effect of the FX depreciation as well. So we have it at 24.9%. It's still above 20% for next year. I think towards the end of next year, it comes down slightly to about 18.1%. And then maybe all things being equal, because
in the long term.
in the long term, we can go back to the preferred band, which was 6 to 9%, but more upper target.
16.
So 6 to 9%.
6 to 9%, single-digit inflation.
Yeah, so
when
9%.
last were we at single-digit inflation?
It's been a while. I think we did see that like about 3 years ago, just briefly. At 9 point something. If you're approximate, it'll take you to 10.
Yeah.
But just briefly. So
Interesting. We talked about inflation forecast. I want to talk about GDP because at the top of the show, I talked about the fact that GDP is probably the most talked about macroeconomic indicator. So the administration during the inaugural speech mentioned this 6% floor for GDP. My question to you, Chinwe, how are we going to get there, and what are you forecasting?
Okay, let me start with our forecast. So it came in at 2.3% for the first quarter of this year, and typically at the first quarter of each year, it's always very sluggish. And then you now kind of see like increments in subsequent quarters. Now, initially, our Q2 forecast, which I think we're getting those figures in August, we're getting the actuals in August, but our Q2 forecast is currently 2.6%. Initially, it was 3%, but given all that's happening now, we've revised it downwards to 2.6%. Now, for full year, we have it at about 2.7%. So a lot of policy actions would be required to get it to that 6% level that the current administration has targeted. I think it's doable. We've seen so many documents, we've listened to so many speeches, and if implementation is taken seriously, I think it's possible that we can get to those levels at least, let's say, within 2 years.
Within 2 years?
Yes, it's possible. From a statistical point of view, it's actually possible. So sometimes, let's not always get caught up with the figures, because sometimes base effects also play a role. And then you can get really high numbers, but is it really reflecting in the economy?
The trickle down effect.
Exactly. Is it really giving? Yes, thank you. Is it really giving us inclusive growth, or is it skewed towards one direction? So with regards to the figure, I think it's doable. But my concern would be, is the real economy actually feeling the impact of those growth figures?
Yeah, good point. And, we don't want to get so technical, but one of the things I wonder is whether this constant trade-off, and before you came on the show, I was talking to you about stagflation. I think we had a small graphic that the producers might put up on the screen. Are we facing the risk of stagflation? You can see here on the screen is when you have low levels of economic growth, high inflation, and high employment. So if you try and curb inflation, for instance, do you then risk dampening economic growth? I mean, is this where Nigeria might be heading, or what do you think? How are we going to get this balance right? We want to boost the economy, but we don't want to raise interest rates too high and cause a recession.
It really is tough, a tough spot for policy makers right now. And economically speaking, we are there already, because we're talking about high inflation rates, and I'm telling you projections are pointing towards further upticks. Growth sluggish, not above 3%.
Unemployment is like 33%.
Above that. Because those are the last figures that are in the public domain. So I'm sure when they do release, it would be above 33.3%. So we're already there. It really is a tough spot for policymakers. So a complex mix of policy actions would be required, because one understands the need to increase rates, and one understands the need to reduce rates to boost growth. So it's as you said, finding that balance.
So if you were looking at all the policies, I think we're sort of coming up to the session now. All the policies, policy pronouncements that have been made so far. Subsidy removal, FX reunification, interest rate decisions. Now we finally have a ministerial list. If you were casting your crystal ball down a year from today, or let's go as far as a year. Let's say January 2024. What is your outlook for the Nigerian economy? Where should we expect to be on some of these key indicators? And maybe not so much on the numbers, but in just terms of general economic sentiment, investor sentiment.
To be very honest, let's say end year, because if you say January, then it's more end year figures. I would say status quo to a large extent. I'm a bit optimistic with regards to FX, believing that the liquidity sources that have been mentioned will come into play, and so just mild appreciation in both market. Well, in the what was called NAFEX, and then what we call the parallel market now. So I expect like status quo in a sense. Not much would change. I believe that significant changes will happen, let's say Q2
of next year.
Yeah.
Okay, all right. Thank you so much, Chinwe. Great to have
pleasure.
your fabulous economic insights, as always. That was Chinwe Egim, Chief Economist at Coronation Merchant Bank, where she's also Head of Economic Intelligence.